Welcome back to the Commercial Property Podcast. And today I'm going to be talking to you about sentiment in markets. And, why is that important for commercial investors? Well, it's important because this is what governs markets. And I'm not just talking about commercial property, I'm talking about all investment markets. So whether that's stocks and shares, whether that's bond markets, whether that's residential property, commercial property, sentiment governs markets. So what is sentiment? Well, sentiment is emotion. Now every investor, as last time I looked in the world, are human beings. Obviously, machines are starting to take this over, so we'll see where that one lands. But at the moment, all investors are human, and obviously we have a variety of tech tools that might help us, but ultimately we invest how we feel. So we might read up on topics, we might get some education, we might have an understanding because we've worked in an area or we've decided to focus on it, and therefore we will invest in that particular product, whether that's commodities, whether that's bonds, whether that's stocks, equities, whether that's real estate. So we have our chosen investment strategies, and we might invest in all of those as part of a balanced portfolio. But we're doing it because we want to get returns, and there's always a balance between risk and return. So we're constantly, even if we don't realize it, assessing that risk and return. And we will be watching the market, because if we're a good investor, that is, and some investors will not watch the market and will just ride it out and just put money away, and that's a valid strategy for some investors. If you're an active investor, what you want to do is you want to understand the market so that you can work out what to invest in, when to divest, where the areas of risk are, and that's how we calculate our investments. That's how we work out our portfolios. Now, it's very easy to think that, just because you've got a high paid city job, either in New York or in London or Paris or Frankfurt or wherever, or you've been doing this stuff for 30, 40 years, 20 years, whatever it might be, that you're a highly rational investor. Now, some investors are more rational than others, but ultimately most investing comes down to emotions. And that's just a fact. If you look at emotions, and if you look at what's happened in boom and bust cycles, largely they have been driven by emotion, by feelings, by confidence, by uncertainty, by optimism. People behave differently depending on how they feel. And so if you take 2008, there was definitely a growing nervousness in the market, and it's almost like there was like a ball ready to be teed off, and the thing that properly teed it off was the banks going under. That set in train a series of events that led to a global downturn. Now, did that need to lead to a global downturn? Well, I suppose there's an argument to say that potentially, banks were overstretched and that there needed some form of correction from that perspective. But ultimately, what happened was that there was a run on the banks. People got nervous. Feelings came in. They got worried because a bank that had previously never anybody had thought like a bank of their size could go under, and so feelings worsened. Emotion worsened, sentiment worsened, and therefore wide scale panic happened basically. And I was working in the corporate world then, and commercial real estate pricing, it almost halved in 2008. Now, there was no reason why the fall of a bank would trigger a halving of commercial real estate values. That is purely sentiment. That is widespread panic. And of course, it might not be your sentiment. It's just the general sentiment in the market. And it's difficult to go against the sentiment. If 90% of the market is feeling jittery and worried, panicking, then you're going to be kind of carried along on the rush. So why am I talking to you about this today? Well, this is a really fundamental aspect of investing, and it's really important to understand it because you can understand how perhaps your behavior is drawing is affecting your investing, but also you can understand how other people's behavior is affecting the market, and therefore you can take a highly rational approach when you're witnessing this and take advantage of the opportunities. And ultimately, that's what we want to do. We want to be contrarian investors. We want to see what's happening. We want to take a rational, calm view. And of course, we can be a lot calmer if we've got our own house in order, whether that's, getting everything on longer term mortgages, fixing rates, paying mortgages off, buying things cash, obviously getting rid of assets that we don't think are particularly going to perform going forward. So it's always important to constantly review your own house and make sure it's in order. But ultimately, what we want to do is we want to take advantage of any uncertainty in market. So at the moment, we're seeing hesitation, we're seeing deals take longer, we're seeing buyers potentially sitting on their hands. All you need to do is look at the news headlines in some of the commercial property press. The market's stalled. Already the market has been in a down cycle in the commercial property market in the UK. So this is just one more thing to tip it over the edge. And I'm not saying that the edge is going to come. When I'm saying the edge, I just mean that sentiment is worsening. So it's not because there are still opportunities in the market. So sentiment has got nothing to do with that. Sentiment has just got a feel about it. And of course, when sentiment is high, then prices go up. That's the logical conclusion. So everybody's feeling really positive. They think that they can make a lot of money from their investments. They're willing to pay more for it. Banks lending is more relaxed. And tenants are more willing to take space, and you feel much more punchy. You're happy to pay a higher price because you know that you're going to be okay. Probably you're feeling good about it. The market's telling you, the way the market's performing is telling you that actually you're going to be okay. So as long as you buy the right property in the right location and you understand tenant demand and all the fundamentals, you're probably going to be good. So market sentiment is just the mood of investors, and it's not data. It's not data led. So a machine would not feel this. And so this is why it would be interesting to see whether AI led investing and machine led investing at some point potentially might kind of change these kind of markets. But at the moment, we're very firmly in a sentiment-led market. So, and of course, depending on the pair of spectacles you're wearing, you see problems or opportunities. And this is what I've been talking about for the last couple of years about the window of opportunity, because one person's problem is another person's opportunity. One person's kind of high risk market is another person's high opportunity market. So interest rate rises, one person might see huge risk, the other one sees opportunities and less competition in the market. Vacant properties, one person maybe who hasn't got as much education or knowledge might see, gosh, a big problem, how would I let that? If you've got some knowledge, you understand your investing location, you probably see a lot of opportunity there as long as it's the right property. So the same headlines, same data, completely different actions. And this is where sentiment comes in. Sentiment is the filter through which the market views reality. And if you remember nothing else of this podcast, remember that sentiment is the filter through which the market views reality. So we're not actually seeing things as they are. We're seeing things through a gauze, which basically, depending on our level of experience, our knowledge, our gearing, our risk profile, will filter how we're feeling about the market. And what I really want for you is to see the opportunities. Obviously we see the problems as well, but we can reframe those problems into opportunities. And that's the name of the game. That's how to be a successful investor. So when sentiment is high, what happens? Well, everyone's buying, prices get pushed up, yields compress, yields go down, therefore prices go up. And risk actually often increases because you're buying at higher prices, but it doesn't feel like it at the time. It feels like you're cashing in on a great market, you've done great deals. What a lot of people obviously do in that kind of market is not do sensitivities on market falls. So they might find themselves over leveraged, they might find themselves over rented, or whatever else it might be, or might find their tenants are over rented. When sentiment's low, then buyers hesitate. We quite often see, and what we've definitely seen in this market, a gap between buyers and sellers. So we see, sellers wanting a high price, their motivation hasn't increased enough. And we see buyers saying, well, I'm not going to buy property at that price. So we kind of have some kind of stagnation in the market. Sellers eventually become more flexible, so that's obviously a good thing from a buying perspective. Deals sit on the market longer. Certain deals go quickly and are going quickly at the moment. So if you look at permitted development opportunities in the southeast, you wouldn't surprise me if you've been to see a property where there might have been 20, 30, 40 viewings on that. Just think to yourself, is that the kind of property you want to buy, given all that interest in it? Is that going to push the prices up more than is realistic? And a lot of small permitted development opportunities don't work actually at the moment, especially at a buy price that's too high. But when sentiment's low, these opportunities increase because more people are seeing problems, there's less people in the market, and the number of opportunities increase. And of course, eventually what happens in the market is that sellers become more motivated. And, if you're ready and waiting to take advantage of that motivation, we always want to make sure it's an ethical win-win, but we can actually help vendors solve their problems that they potentially have. So these fundamentals don't change overnight, but sentiment does. Fundamentals, a property is a good property to invest in, whether it's a down market, an up market. There's great tenant demand, the future looks good. But sentiment governs the price that will get in different types of market. And sentiment, therefore, kind of produces mispricing. It produces the wrong pricing in a market. So the sentiment cycle, if we think of the market cycle just like a sentiment cycle, then first of all, we have optimism, the market's heating up. And then there's euphoria, you just can't lose, everyone's making money. I don't know whether you remember in the 80s, 90s, there was a program called Changing Rooms, and it was, and there was one called Property Ladder. There was all these property programs where amateurs would buy residential properties and they would do them up, and they'd always overspend on them, but they'd sell them at a great price because they were in a growing market. And so honestly, any fool could have made money in property at that point. That's what I'm talking about. It's this euphoria, I can afford to put my own personal taste on this property, despite Sarah Beanie telling me that actually it's just an utter waste of money, because I'm going to get the money at the end of it. So you're in this euphoria where things just work. Then you've got you kind of reach a pinnacle where things start to slow down. And there might be some things happening in the global economic context, from a wider perspective. There might be some kind of economic shocks that are starting to happen, or it might just be that things are looking overpriced. They're looking too punchy. Perhaps you might have got people might have got their fingers burnt by buying a bit high. Maybe interest rates are going up, maybe inflation's rising, whatever it might be. But then uncertainty starts to enter the market, and then hesitation begins at that point from investors. And then you get uncertainty that definitely then pivots into fear, kind of light fear at first, and obviously then that gets greater and greater. Activity slows, and actually opportunities present themselves much more. And then obviously once we're out of that, the bottom of the cycle, then we start seeing a recovery and the cycle starts again. Because there comes a point at which opportunities are so great, lending might loosen itself up, global headlines are more positive, and that will start to loosen the market up. So where are we at the moment? I think we're in the uncertainty phase. I think we're at uncertainty, potentially moving into fear this year. And, that they really are where the best opportunities are. And just a side note, you can wait for the bottom of the market as long as you want, but nobody really ever knows, and unless they're looking backwards. where the bottom of the market was. So don't sit on your hands waiting for the bottom of the market. We're in the market at the moment where if you can buy at the right price, and I'm pretty bearish at the moment. I'm working with clients, and I just don't want them to overpay. And yes, they're losing deals, but this market's a waiting game. This is a game where you wait for vendors to become more motivated. You wait for properties not to sell for a longer period of time. You wait for vendors that are more motivated. Don't be a motivated purchaser in this market. You don't want to be, I'm desperate to find, my first deal or whatever. You want to be very measured with your pricing at the moment. And historically, the phase we're at now is where some of the best opportunities have presented themselves. We can look back over time and different cycles. So
this episode is brought to you by Bond Finance Limited, your trusted partner for commercial property mortgage solutions. Are you an experienced residential property investor about to diversify into commercial property, looking for funding options? Bond Finance can help. Whether you're planning to expand, refinance, or make a major property investment, Bond Finance provides expert advice with access to a wide range of lenders, from high street to specialist. Book a free discovery session today to explore how we can tailor commercial funding solutions to your unique investment strategy. Visit www.bondfinanceltd.co.uk and take the next step in your commercial finance journey.
Commercial investors use this to their advantage, and this is very much what I'm working with my clients at the moment. This is not a market to come into with a lack of knowledge, because you really can overpay, make mistakes, buy the wrong type of property, not understand how to add value. You always want to have value add opportunities in this market. And that lovely expression about luck happens where preparation meets opportunity is really true at the moment. You need to have the fundamentals. You need to understand what you want to invest in. You need to understand your niche. So I work a lot with the board. I've just started the first board with a new intake of clients, and the very first thing we work on is starting with the end in mind and working out niching. Finding niches that suit your own personal investing criteria, and making sure that therefore that when the opportunities arise, you've got the relationships, you've got the knowledge to get those opportunities and bring them into your portfolio quickly and at the right price. So commercial investors use this to their advantage because they don't follow the crowd. They, if something feels safe, and, the example I gave earlier about the permitted development opportunities, the small, maybe shops with uppers in the southeast, I'm seeing those as really overpriced at the moment. Because it feels safe, you can do your conversion, but actually, if it feels safe, then very often it's overpriced. So, if you're not you're not buying at the right price, you're not putting the right build conversion costs in. Commercial investors who are doing this well look for hesitation signals. They're looking for properties sitting on the market for a long period of time. So you can get some add-ons into Rightmove and Zoopla Commercial in Google, where you can actually see how long things have been on the market. Property Filter's great for this as well. They're looking for price reductions. They're looking for motivated vendors. One of the first things I say to agents is, why is the vendor selling? What's the background? They're looking for poor marketing. This is where you don't go on the portals, you go onto local agents' websites, where things maybe are not being marketed properly. You look for when agents are really aggressively chasing buyers, that's a sign of real motivation. It's all that, basically all of this is sentiment in action. So look out for those triggers. Also, if you're, if you're looking at this the right way as a successful investor, you double down on fundamentals while others panic. So you're looking for properties, you've done your work on your niche. You're looking for strong tenant demand. You're looking for great locations, sensible pricing, and very importantly, you're looking at how you can add value. You want to be adding value to these properties so you can force value through. This is not a market to be relying on the market for market increases, for price increases. You want to be taking matters into your own hand and forcing value through. So when sentiment's low, you don't ignore risk. Far from it. In fact, you weigh up all the risks very carefully. You just get sharper with it. You just understand it. You understand where the opportunities are despite the risks, and you make sure the fundamentals are absolutely right in terms of what you're buying. And you create value where others see problems. So others will see problems in empty properties, short leases, under-rented units, maybe properties that need some work doing to them. This all feels really scary in low sentiment markets, but actually to the experienced investor, somebody who understands how commercial ticks, it's exactly why they're opportunities. So, you're actually actively looking for vacant properties, you're actively looking for short leases, but obviously you still need to make sure the fundamentals of those properties is absolutely 100%. So some investors get this wrong. Sometimes in these kind of markets, some investors do the absolute opposite of what works. They buy where the market feels good. They'll bail opportunities where there's no value to add. They'll hesitate when markets feel uncertain. They'll let headlines dictate their decisions and won't actually see through those headlines. If the Daily Mail, the Daily Express is crying foul of the market, that's exactly when the opportunities are there. And investors can confuse comfort with good investing. If it feels comfortable, it might not be the right thing for you to invest in. So just have a little reflect on that as a concept. So this is why I've been talking about the window of opportunity for some time. And this is why I can see that window definitely getting further and further open. Like, I genuinely think 2026, 2027, the window of opportunity is going to be even greater than we've seen. But obviously you need to pick and choose your opportunities. And, you need to make sure that you're in the right niche, the right location, you've got strong tenant demand, you understand your financing. And, so you need to be niche led. You need to buy in locations where there's good demand and limited supply. You need to absolutely focus on tenant demand, rents, lease lengths, etc. You need to buy opportunities where you can add value, you can force value through, get the fundamentals right, and do proper due diligence. It's really, really important. This isn't about blindly kind of stumbling in a market full of fear. It's about intelligently buying when others hesitate. That's what we're looking for. So this is the kind of thing that I go through really deeply with my clients on the board. Whenever they have opportunities, I will kind of hold their hands with those to make sure that they know kind of what to do, how to do the due diligence, make sure they're buying at the right price, and making sure that they can get all the due diligence that backs that up, so that when they actually transact, they know that they have got a plan. In fact, they've got multiple plans, because multiple exits is especially important in this market. Don't just have one get out of jail exit, have multiple ones, so that if plan A doesn't work, you can quickly pivot to plan B, C, D, E, F. That's what I work on with my clients every day of the week. And I just can't emphasize enough how important this market is. We see these markets come along once in a decade, once every 15, maybe even 20 years. And, it's so important to take advantage of it. This is when kind of wealth is created in markets where others are feeling hesitant. But you've got the fundamentals and you know what you're doing. So sentiment is a really important driver of markets. And the market doesn't reward the most informed investor. It rewards the investor that's well informed and will act when others won't. But they do that on really strong foundations, really strong fundamentals. So keep an eye out for those headlines. Keep an eye out for those properties that have been on the market a long time. Keep an eye out for motivated vendors. Make sure you understand your niche and look for the opportunities in your niche. And potentially this window of opportunity could absolutely play in your favour for at least the next 6 months to a year. So watch this space. I'll update on the market and kind of where we are as it goes. But otherwise, I will see you next time on the Commercial Property Podcast.